Welcome back, folks, to Investor Diaries. In this video, we'll speak about a company that has seen a dramatic decline in its share price over the past few months. In fact, the stock has fallen by more than 50% over the past year. Yes, we are speaking about the energy company STEM Inc., which trades on the New York Stock Exchange under the ticker symbol STEM. And folks, if you've not already done so, please smash the subscribe button right now to ensure that you receive the latest and greatest content from Investor Diaries.
If you're wondering what STEM does, we recently did a video on the company overview, and we'll leave a link to it below the like button so you can check it out. Over the last few weeks, we've received a lot of requests to do a video on the STEM updates. So here it is. And just to give you a background, the company came public in late 2020. After an initial rally on its debut, the shares have gone into a tailspin. Now, can the stock really rebound in 2022? Is STEM another forgettable company with just empty promise statements, or does it have some growth potential over the next decade for patient investors? Should you buy, hold, or sell STEM stocks? Let's find out in today's video.
All right, so very briefly, the company operates smart battery storage solutions that maximize renewable energy generation and also helps ensure that there's a resilient grid. STEM's customers include Fortune 500 corporate energy users, project developers and installers, and also utilities and independent power producers. Its primary product is Athena. Athena is an AI-powered analytics platform software that uses AI and machine learning to automatically switch between battery power, on-site generation, and grid power.
And yes, like we described in our last video, we are very bullish in STEM. STEM's use of AI is what excites us the most. The company pulls data on weather, energy usage, real-time energy prices, and even the time of day to optimize use. It then brings all this data together to make its customers' energy consumption the most cost-effective by automating the expenditure of energy. In other words, the company is making renewable energy more practical by tearing down barriers and past problems of green energy.
One other reason we believe in STEM is because green energy is expected to be massive over the coming decades. The market of global energy storage is expected to grow 35 times by 2030 at a compounded annual growth rate of 35%. Additionally, STEM estimates that its addressable market will become 25 times larger by 2050, worth $1.2 trillion by then.
Okay, so let's address the elephant in the room. In the last 1 year, the stock price has fallen by more than 60%. It is currently languishing at about $10 per share from the high of $37.79. Clearly, this is an issue, and it's causing a lot of pain to all the existing stockholders. Let's look at what the numbers seem to suggest.
So in Q4 of 2021, the revenues grew 184% to $52.8 million from just $18.6 million a year ago. The net loss narrowed from $100.9 million in FY 2020 to $34.1 million in FY 2021. With low profitability margins, STEM's acquisition of AlsoEnergy is the first step in the right direction to capitalize on software's high margin while simultaneously expanding hardware sales. Synergies between the two companies could justify the $695 million paid on AlsoEnergy's acquisition, which is further spurred by the 30% overlap in the existing customer base.
But here's the thing. Revenue numbers look good, and we don't think there's an issue with it. The current concerns for STEM would be the turn in profitability and evaluating the risk of further capital funding and subsequent dilution for current shareholders. Last 12 months gross margin was at 4.6%, which is rather unfavorable and is expected to be 22.3% only in 2024 fiscal year.
And in terms of guidance, STEM's recurring software cash flow is secured by long-term, which is 10 to 20-year contracts, and that provides stability, minimizing revenue variances. We believe that further software acquisitions could be highly beneficial for STEM as the current margins are high, which is 60 to 80%, with software only accounting for 19% of the total revenue.
Currently, the average target price for STEM by the analyst group is around $20 per share. This implies a greater sense of analyst conviction and certainty. At the current share price, this provides for over 100% upside.
Due to the Ukraine Russia conflict and the prices of crude oil reaching 13-year highs, there would inevitably be an increasing macro spur need for the energy cost related optimization. So we believe that STEM would be able to meet its F22 revenue guidance. However, investors should compare the upcoming earnings with management guidance for further reassurances.
Now, not everything is rosy. If everything was, then the stock price would have not been so suppressed. Supply chain disruptions could work against profit margins for STEM. Despite lithium ion battery packs prices plummeting from $1,200 per kilowatt hour in 2010 to $132 in 2021, demand has outstripped supply and prices could rise to $135 per kilowatt hour in 2022.
So, as such, there lies uncertainty in the key cost of goods sold input, which can eclipse that of high revenue generation, especially since hardware still comprises 84% of F21 total revenue.
Overall risk of delayed EBITDA and net profits could be actualized if margins are stagnant. With greater expansion costs, potential further acquisitions, and lack of profitability, STEM might require more cash, resulting for greater capital funding at a higher cost and a subsequent shareholder dilution.
All right, so what is Investor Diaries recommendation? We feel that STEM's hardware and network integration sales would act as a conduit between software sales on one side and high profitability on the other side. And as we've mentioned earlier, low margin hardware sales still comprise most of STEM's revenue growth.
FY 2021's record bookings and contracted backlogs were optimistic and will continue in that direction, attributed to rising global cost of energy and their increasing need for energy optimization and intelligence.
So at this point, we believe that the macro factors, including the rate hikes, will act as major headwinds in STEM's journey towards net profitability. STEM still looks ripe for a long-term play, but investors have to be prepared for short-term volatility if they actually are looking for some serious gains to be made over a long-term horizon.
However, this company is for investors with a long term horizon and a diversified portfolio and a large risk appetite. We at Investor Diaries are sticking to a theory of buy on STEM. This stock has a lot of potential, and investors should jump on the opportunity to buy STEM at a discount. We are buyers of STEM at these levels and continue to believe in the company.
Absolutely. So we believe that the recent dip is a great opportunity to load up on STEM stock, buy them at a discount, and then when the stock price goes up, make a lot of profits out of it. We therefore continue to remain bullish on STEM.
That's a wrap for today's episode, folks. Do let us know in our comment section below what you think of STEM and whether you are buying or selling or holding onto this stock. Until next time, stay tuned and stay focused.